Now we're going to talk a little bit about cost of capital. We've been using cost of capital to discount our cash flows, so exactly what makes up our cost of capital, why is it important, and what does it mean to firm value? So we'll be taking a look at each of those questions and trying to provide an answer for those. First of all, the importance of the cost of capital. It is actually extremely important. Firms spend a lot of time going through and trying to determine what their minimum cost of capital can be. And they will adjust their mix of financing, so they'll adjust the amount of debt or the amount of equity that they're currently holding so that they can try to bring that cost of capital down even lower. The reason you want to minimize your cost of capital, or a firm would want to do that, is exactly the same reason why you want to pay the lowest possible interest rate on your mortgage, right? The less you pay in financing, the higher the value for the corporation. You can think of it in terms of net present values. If you have a cost of capital of 12% and you're able to change your mix of financing so that your cost of capital comes down to 10%, then you have just increased the net present value of every single project that the firm owns. That is an alternative definition, by the way, to firm value. Firm value is the sum of the net present value of the projects that the firm has in place. So by minimizing that cost of capital, you are in fact maximizing the value of the firm. And so the points there kind of refer to what I was just talking about here. Now, what are the various sources that are available to corporations in terms of financing? Well, the major sources are bond financing, preferred stock financing, new common stock financing, and retained earnings. And so we want to take a look at each one of those individually and determine what are the advantages and disadvantages of each one of those. Of course, the obvious one you might look at and say, well, what happened to bank loans? Bank loans are also a source of financing, but you'll find they're actually a very minor source of financing for corporations. Banks simply can't supply the amount of capital that corporations need in order to fund their capital budgets. Banks, they have to hold a portfolio of loans, and the amount of financing that's generally needed in the form of debt is so large that they can't supply enough capital to corporations. So bond financing is the preferred source of financing for corporations, although that's not to say that occasionally from time to time corporations will take out a bank loan, but we just don't look at that because technically it is a very minor source of financing. So these are your major sources. I should also point out before I move on that preferred stock is really very rare anymore. We don't see much in the way of preferred stock, but I'll mention it at the end or toward the end of this discussion because you do occasionally see it out there. But certainly bond financing, new common stock, and retained earnings, all those sources of financing are very important. So bond financing, what are the advantages? And there you see a bond certificate. There's a lot of advantages to bond financing. First of all, it is just the cheapest source of financing out there. And I actually am hitting that second point. One of the reasons it's the cheapest source of financing is from an investor's perspective, it's the safest investment in a corporation you can make. Because if a firm goes bankrupt, your bondholders have first claim on assets before your preferred stockholders and your common stockholders. So since they have first claim on assets, that's considered to be a less risky security, and then as a result it pays a lower rate of return. So from a corporate perspective, bond financing pays the lowest rate of return to its investors, and so it makes makes debt cheap. Secondly, the other thing that makes it cheap is that the interest on debt is tax deductible. So that kind of gives corporations an extra advantage in that they can take the interest that they pay out in debt and deduct it from their earnings before they figure out their taxes. So it really makes the after-tax cost of debt even cheaper. Going up to that first point, the other nice thing about issuing bonds is you don't have to share your profits with bondholders. Bondholders simply get their interest each 6 months or annually, whichever the bond dictates, and then that's it. So if you have a particularly great year, your shareholders get all that excess profit. The third point there, the risk-adjusted component cost of debt is lower than for common stock. That's a little controversial, but it's often quoted in textbooks, and so I did include that there. There are some researchers out there and some in the investment world that feel that corporations are really getting a deal when they use bond financing, because the feeling is that an investor is really not getting compensated for the full amount of risk that they're taking on when they buy a corporate bond. Now, personally, I am opposed to that. I think markets are more efficient than that, and I think that our pricing models may be off a little bit when it comes to bond financing. But I did want to go ahead and give that other point of view, because there is that sentiment there as well, that it makes debt financing a bargain because corporations get away with paying a lower rate of return than they should given the risk. And then finally, bondholders don't have any control in the corporation, so they don't have any voting rights or anything at all like that. So stockholders don't have to share any control with any bondholders. So that's another advantage of bond financing. Now, there are disadvantages to bond financing. The first one being fixed charges. And by fixed charges, we've got a couple. The big one is your interest payments. Your interest payments have to be met every 6 months or every year, again, depending on whether it's a semi-annual or an annual bond. And if a firm fails to make those fixed charges, if they fail to pay that interest, then the bondholders can force the firm into bankruptcy. So that's something that firms certainly have to consider when they're determining how much debt they want to take out. You want to definitely make sure that you can cover those interest charges very easily. Secondly, debt financing does increase a firm's what we call financial leverage. Again, because that interest has to be met or the firm goes bankrupt. And so since it increases the risk of, or the financial risk of the firm, then the cost of both debt and equity financing will increase. Now, having said that, the cost of debt increases very, very slowly up to a particular point, and then once you exceed that point, it increases quickly. Equity, on the other hand, tends to increase not necessarily in a linear manner, but does tend to increase every time there's a new increment of debt issued. So it does increase the overall cost of financing for the firm. The third point, there's a fixed maturity, which means, for example, if you took out $50 million worth of debt to fund your capital budget this year, and they're 20-year bonds, that means 20 years from now you're going to have to pay back $20 million to the bondholders, because you've got to pay them back that principal. So you've got that fixed maturity, and you have to have that money available at maturity unless you are able to roll the bonds over. Some corporations will do that, but you're not necessarily guaranteed that you can roll those bonds over, and the firm has to still be financially viable to be able to do that. The next point, restrictive covenants, that's an important consideration when issuing bonds as well, because there is a bond indenture associated with the bond issue. And just very quickly, a bond indenture is a document that tells you everything you need to know as an investor to make an informed investing decision about this bond. And most of your bond indentures are open-ended, meaning that they were really, for the most part, for most corporations, developed back in the 50s and 60s by a team of attorneys. They're very expensive to come up with. And then through the years, they're just added on to as more debt issues are made. And so, as a result, your bond indentures can become quite large. It's not uncommon to see 200-page bond indenture for a company that's been around for a while. It makes for exciting reading. Not. However, there are some very important things in that bond indenture, and one of which is the restrictive covenants. Restrictive covenants are just simply a set of restrictions that the firm must abide by while those bonds are outstanding. And so some examples of restrictive covenants would include keeping certain financial ratios. Another one might be to limit the amount of dividends that you can pay. And these are done in order to protect the bondholder. So, for example, let's talk about the dividend limits. The purpose of limiting the amount of dividends you can pay while these bonds are outstanding is to keep management from perhaps liquidating the firm and paying all that money out to the shareholders in the form of a dividend. If a firm's in financial distress, they might keeping in mind that managers work in the best interest of the shareholders, they would have an incentive perhaps to do something like that. So restrictive covenants are put in place to protect the bondholders so that those types of actions can't take place. There is a trustee that's assigned to each firm, and that trustee is there to make sure that the restrictive covenants are carried out. And then finally, the last point is the cost can be very high outside of an acceptable range of financing. That kind of gets back to the second point I was talking about earlier. As you do issue more debt, the cost of debt goes up very, very, very slow in the beginning, but then there comes a particular point when the market determines, okay, if you take on any additional debt, you are becoming overly leveraged, and the cost of debt will spike up very, very quickly. And I think the best example of that would be to think of your personal credit card. The banks have determined that based on your cash flow, you are good for so much debt. And once you exceed that credit line, then what generally happens is the bank will start charging you a higher interest because you've exceeded your credit limit. You'll have extra charges thrown on top of that, so the effective interest rate will climb very quickly. And so it's kind of the same idea with companies as well. The market thinks, okay, this company is good for so much debt, and then if a company exceeds that amount of debt, then bondholders will react by requiring a much higher rate of return. Now, there are many different types of bonds, and this certainly is not all the bonds that are out there. I just kind of picked a few that were kind of interesting and some important ones. So the first one I'm going to refer to is mortgage bonds, and they are also referred to oftentimes as senior debt. They're the only bonds that are issued that are collateralized by some type of real estate. So they are the safest corporate bonds you can purchase in terms of types of bonds. So it's not a dollar for dollar collateralization. Usually it's roughly around 40%. But if a firm were to go bankrupt or file bankruptcy, then your mortgage bond holders would get the money that those bonds are secured to. And so if there's a piece of real estate, that real estate would be sold, and then the proceeds would go to the mortgage bond holders. So only companies that have real estate can actually issue mortgage bonds. So .com companies wouldn't be able to issue mortgage bonds or senior debt, as it's often called. Anything that's unsecured, so any type of debt that's unsecured, is referred to as debentures. So any company can issue those, as long as they meet the criteria, to issue bonds. You have to be a public company and be registered with the SEC and so on. But debentures just simply means an unsecured bond. So they are of higher risk. They are rated. We'll talk about bond ratings in a minute. And so any type of bond can be a debenture. And again, I'll talk about that some more in a minute. Then as you issue additional debentures, some debentures then that you perhaps issue later will be subordinate to the debentures that you issued earlier. So it just simply means that, again, if a firm were to go bankrupt, if they have real estate, your mortgage bond holders would get that first, then your debentures would get claim on assets, and then subordinate debentures would have claim on assets after that. So those three are really classes of bonds. Now, the last 4 points I've got there: convertible bonds, income bonds, zero coupon bonds, and floating or adjustable rate bonds. Those are different types of bonds, just to kind of give you some examples. Convertible bonds are very common. These are bonds that investors can convert to shares of stock in the future at some predetermined price. And so those are kind of nice from both an investing perspective and from a corporate perspective. So let's say that you own a convertible bond of a company, and when you bought it, the stock price of the company was $25 a share, and while you're holding this 25-year bond, you have the option of converting the $1,000 par value at a price of $35 a share for common stock. So in other words, if you want to use the $1,000 par value to buy common stock at a price of $35 a share, you can do so. Well, if the current market price of the stock is $25, it certainly wouldn't make any sense at all to make the conversion, because you'd be converting at a higher price than the current market price. But let's move 10 years forward. This is a 20-year bond, so let's go 10 years down the road, and the firm's done really well, and hey, the stock price is up to $70 a share. Well, you have a convertible bond that will allow you to convert the par value of that bond into shares of stock at a price of $35 per share. So if you want to exercise that right, you can do so and buy $1,000 worth of bonds at a price of $35 a share, even though those bonds actually have a market value of $70. So you will realize an immediate capital gain. So from an investor's perspective, it's kind of nice because it gives you that flexibility. And so convertible bonds tend to pay a slightly lower interest rate because you do have that flexibility. From a corporate perspective, it's kind of nice too, because they get the slightly cheaper interest rate to pay out. And the other thing is, if everyone converts over to bonds, or if you get a lot of people that convert, not to bonds, to stocks. If you get people that convert to stocks, then you have a smaller amount to pay off when the bonds actually mature. Income bonds, I threw that one in there because they're really one of the newly engineered bonds out there. They're really more like a preferred stock. An income bond is the only bond out there that if you do not have the money to pay the interest on the bond, you cannot be forced into bankruptcy. It's the only one. So what happens is any interest payments that can't be made goes into arrears, 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 and then all arrears have to be paid up before any common stock dividends can be paid at all. Zero coupon bonds, these were popular with corporations back in the 1980s. Not so much these days, but I mention these because they're used quite a bit by government. Kind of like the name implies, these are bonds that do not pay a coupon interest rate. They pay no interest at all. So you think, why in the world would you want to invest in one of those? Well, you still get a rate of return. It's just in the form of capital gain. And so it's actually an attractive investment for higher income tax bracket investors, because what they'll do is they'll buy a bond at a very deep discount. So let's say that you buy a bond for $300, very deep discount, and it's a 15-year bond, and you hold it for 15 years, and in 15 years, over that 15-year period, you're not receiving anything, but then at the end of the 15 years, you do receive the $1,000 par value. So you ended up making $700 in the form of capital gains over that 15-year period. So that's the way the zero coupon bonds work. And then I added that last one, floating or adjustable rate bonds or debt, because I get questions about that sometimes. In the U.S., we don't issue those, or if we do, I'm not aware of any. I haven't seen any. But there are other countries, particularly South America, where you will see floating or adjustable rate bonds. So in the U.S., when we set the interest rate on bonds, it is permanently fixed and until the bond matures, and so the price of the bond will fluctuate depending on changes in market interest rates. However, in other countries, like I said, South America has several countries that are big on adjustable rate bonds. The bond price will stay constant, but the interest rate on the bond will change. So just kind of a interesting type of bond. Can any firm issue bonds? Well, I kind of mentioned this before. First of all, you have to have access to capital markets. You have to have a market for your bonds. In other words, you have to have people that are willing to buy it. And actually, it's more than people. It's really, you have to have corporations that are willing to buy it. The largest purchaser of corporate bonds are other corporations. So, your insurance companies, your investment companies, banks, those are all very large purchasers of corporate bonds. And bond ratings are critical because most of these institutions that purchase bonds will not purchase a bond unless it has a BBB rating or higher. So if your bond rating falls below a BBB, and I'll show you that and talk about it more in just a moment, then you will have to, you'll have a hard time selling your bond. And then, as I mentioned before, you have to create a bond indenture. And if it's not, it's probably already created, but you'll have to add to it any current information that would be relevant to an investor. How do you repay bondholders? Well, we have what we call sinking fund provisions. And oftentimes what a corporation will do is pay off a certain portion of the debt each year. So there's two ways in which they can do that. They can either go out into the open market and just buy up a certain portion of their debt each year, or if they issued what we call callable bonds, then they can just call in so many of the bonds each year. And callable bonds are very common. They'll have a serial number attached to those bonds, and if you're holding a callable bond and through a computer-generated lottery, your serial number has been called in, then you will have to cash your bond in. And then what the corporation will do is they'll give you that year's interest that's due to you. They will give you the par value of the bond, and then they usually give you like a little consolation gift that's called a call premium, which is just a little extra money for having your bond called in early. They're not legally obligated to pay that call premium, but most firms will do that. Which of the two options do firms generally use when doing a sinking fund provision? They'll do whatever's cheapest for them. So if the bonds were issued 10 years ago and market interest rates have dropped, that means bond prices have gone up. So they are not likely to go into the open market and pay some large premium for the bonds. Instead, if it's a callable bond, they'll call it in. They'll exercise that call provision and call it in and just pay the par value plus some call premium. And of course the interest that year. And obviously if the opposite is true and you issued the bonds 10 years ago and since then market interest rates have gone up, the value of your bond has gone down, and so your bond is likely selling at a discount in the open market, and so that'd be a perfect time to go into the open market and buy back your bonds at the current market price. Now, in terms of rating agencies, as I mentioned before, bond ratings are very important. There are three major bond rating agencies: Moody's and Standard & Poor's, which are the two biggest, and all your Fortune 500 companies, actually probably all your public companies, subscribe to those two rating agencies. Fitch's is the third one, and most of your companies also subscribe to Fitch's. And when I say subscribe, it is the companies that actually pay for the services for these rating agencies to come out and rate their bonds. So the purpose of rating your bonds is so investors know exactly how safe the bond is, and it also tells the corporation what rate of return they need to pay on those bonds. Some people will complain that there's a conflict of interest. I mean, if you're paying Moody's and Standard & Poor's and Fitch's to rate your bonds and you can drop them if you want, why would there be an incentive for them to give you a low bond rating? But even though there has been some evidence of conflict of interest in the past, and that's kind of a longer story than we have time for right now. For the most part, they're pretty straight. They do have to publish, and I'll show you in a slide in just a bit, they do have to publish the defaults that occurred for each of the bond rating categories, and that helps keep them in line in trying to make sure that they properly rate the bonds. One reason Fitch's has emerged and has become popular is sometimes Moody's and Standard & Poor's might give a company what's called a split rating. In other words, they might not agree on the rating, and so Fitch's kind of serves as the tiebreaker for the two. And so that's why some companies will go ahead and go with all three companies rather than just the two. But not everybody uses Fitch's. This slide just kind of shows you what the ratings look like, and so you can kind of see they all are very similar. So the highest rated corporate bond with Moody's you see is a AAA, same with Standard & Poor's, I'm looking at the long term, and same with Fitch's. So you can see the ratings are just very, very similar. Again, once you get, I like the Standard & Poor's and Fitch's ratings because I just kind of think they're a little bit more straightforward. You'll notice there are some subcategories in between. So, for instance, you've got AAA, which is the absolute safest corporate bond, and then there's AA, but there's a AA plus, a AA, and a AA minus. So there's three categories within that AA. So it's kind of like a plus, A, or A minus in terms of a grade. So anything that has an A rating is considered to be very safe. Triple B, triple B minus, if you fall below that, you're referred to as a junk bond, because as I mentioned before, it's very difficult to sell your bonds because most institutional investors will not buy them if you fall below a triple B rating. So anything with a triple B or above is investment grade, and anything below a triple B is referred to as a junk bond or the speculative bond, and you can see that there. And as you go all the way down to the ratings, I'll go all the way down to a D, and a D literally means you're in default. A C generally means that you're about in default. So this is the publication that I was talking about that tells you, this has to be published by each of the bond rating agencies to show, are they doing a good job in rating companies. And you should never see any defaults in anything that's A rated. And of course, we know back in 2007, 2008, when we had the Great Recession, that's where there was a lot of criticism about the bond rating agencies because they did mess up. And you can see there that you had 2.1% of AA rated firms defaulting. That's the way you read that. And A rated firms, you had 2.23% of A rated firms defaulting. And in 2009, we had a few A-rated firms defaulting. And also, I guess, in the year 2000. Those should all be zeros. And so, this is Standard & Poor's report. And so, they were off a little bit. Moody's, it was the same thing for Moody's as well. So, they tried to correct that. A lot of that had to do with the securities associated with the subprime mortgages and all that. But yeah, we should see all those being zeros. Unfortunately, I don't have more recent data because it costs to get more recent data, so I got the free stuff. But this gives us an idea of how those reports, what they look like. Now, obviously, as the ratings get lower or riskier, so when you get to a triple B and a B and a B and a triple C and a C, you expect a higher percentage of defaults, right? And so if you look, that trend tends to hold pretty well there for Standard & Poor's. So with the exception of 2008, 2009, Standard & Poor's tended to do, I think, a pretty good job in terms of rating companies appropriately. I kind of went a little graph crazy here. This is from that same report. I like this. This just kind of shows you what the title says. It's the cumulative default rates by rating. And so, for example, and the curves look like they should look. You'll see the orange curve there are AAA rated bonds. And so if AAA rated bonds defaulted, it took them, if you follow that curve all the way up, let me see if I can get my laser here. Sorry, there we go. If you follow this curve up, what this is telling us is that you have a little over 1% of AAA rated firms that default within a 20-year period after they've been rated. So, you don't see AAA firms hardly ever defaulting. And then AA rated firms, that's your green line. Again, it's just, here you're at 1%. So again, just slightly over 1% maybe that could be roughly 3% of your AA rated bonds default within 20 years after they were issued. And then obviously, the lower the firm is rated in the beginning, the higher is going to be the percentage of defaults within a 20-year period. And so, all these lines, and this is something else they have to submit in their report. So all these lines, kind of indicate that they do a pretty good job of rating these companies. This one again, it's kind of the same thing, only in a bar graph. The average time to default from the original rating, and this is from 1981 to 2011. So again, for AAA bonds in the U.S., there were 6 U.S. firms that were rated AAA, and then 18 years later defaulted. There were 7 global firms, okay, so outside the U.S., that defaulted within a little over 16 years. And then with A-rated firms in the U.S., 25 that were originally AA rated defaulted in a little under 16 years. So it took them a long time to default. And of course, in 16 years, a lot of things can happen. And then globally, about 28 firms in roughly the same amount of time defaulted. So again, just something that's just kind of interesting. Like I said, I went a little graph crazy. I like all these graphs. I can talk about bond ratings forever. And so here, this just tells you how many firms get AAA rated, A rated, or AA rated, A rated, triple B rated, and so on. And if you'll notice, U.S. tends to be pretty strict. AAA rated bonds are pretty rare. We don't have a lot of those. Globally, still very small. European Union tends to have the most. They tend to be more lenient with bond ratings, and then emerging markets are kind of, it kind of varies. Sometimes they're tighter, like you'll see with this with the AA rating. They're really tight here, and versus the B rating. So it just gives you an idea of what proportion of companies have the different bond ratings. So you'll see for the U.S. we have very few firms with a AAA, considerably more at the AA, A much more, and so on down the line. So to just kind of provide you with some examples here, what's an example of a AAA rated bond? Well, GE used to be my prime example, but GE lost its AAA rating back in 2009. So I think it was 2009, October. So Johnson & Johnson is my new example for a AAA rated bond. There's very few AAA rated. I think Johnson & Johnson, ExxonMobil is one, and Microsoft. Those are the only 3 I know of off the top of my head right now. Well, along with Johnson & Johnson. So, or I guess that includes Johnson & Johnson. So, very few that are triple rated. Google is AA. Caterpillar would be an example of an A-rated bond. Ford Motor Company, I think at this, I know as of a couple months ago it was still investment grade, triple B rated, and I think if anything it might be going up a little bit. Best Buy fell to a double B rating, so that was kind of big news when they fell in 2014 down to a double B rating, because they fell from investment grade. Sprint is at a B. Radio Shack having problems, was at a triple C, and then I couldn't really find any company that we would recognize with a double CC or a D. But I mean, you can look them up; they're out there. Okay, so now to stocks. Um, we do have common stock financing as well, and there are many advantages to common stock financing. There I've got a picture of the Walt Disney stock certificate. Uh, the Walt Disney Company is really one of the last companies out there to actually issue stock certificates. Everyone else has gone electronic. They did it for the longest. They just stopped doing it, I think, in 2014. They kept the stock certificates up because they were oftentimes used as gifts by parents and grandparents to kids, and framed and everything. They were kind of neat. But they have now also gone electronic. But when you own common stock, you basically have the right to receive dividends, and you do have voting rights in the firm. But from the firm's perspective, there's some advantages in it, and that is that there's no fixed charges. Now, you definitely want to pay your dividend, because if you don't pay your dividend, your stock price is going to get hammered. But you're not legally obligated to pay that dividend if you're not able to. In other words, you can't be forced into bankruptcy if you miss that dividend payment. There's no fixed maturity date, so common stock can stay out there forever. Common stock does increase the creditworthiness of the firm because it's thought of as owner's capital, right? Your stockholders are the owners of the firm, so the more owner's capital you have, the better your ownership base, the more ownership money you have for the firm. And so that in turn increases the creditworthiness of the firm. And then finally, it's sold much more easily than debt. It's sold to a very wide audience, and many different investors, not just your financial institutions that are buying common stock. Disadvantages: there are certainly some disadvantages. Loss of control. It is possible for an outsider to perhaps get a controlling number of shares and take over the company. We refer to that as a hostile takeover. So you have to be careful about that. As you issue more shares of stock, you do dilute the earnings of the company. Okay, because keep in mind the earnings of the company are paid out to investors in the form of dividends. So the more shares you have out there, the fewer earnings then you can distribute to those investors. It is a very expensive form of financing because from an investor's perspective, it's the riskiest security that an investor can purchase of the firm. So it has to pay a higher rate of return. On top of that, you have to pay an investment banker to underwrite and distribute the common stock whenever you issue new common stock, and that is also expensive. The other thing that makes it expensive is that the dividends are not tax deductible. So the dividends are paid from after-tax earnings, so you don't get that tax break with common stock like you do with debt. And then finally, when you issue common stock, it's oftentimes perceived negatively by the market. And the reason for that is put yourself in the position of the CFO of a company, and you're trying to determine if you want to issue debt. Okay, you need money for your capital budget. Do I want to issue debt, or do I want to issue new common stock? Well, I'm certainly not going to issue new common stock if it's underpriced right now. Okay, as an insider of the firm, I really have a good idea as to what the intrinsic value of that stock really should be. And so if I feel like the intrinsic value of the stock should be $80 a share and it's selling right now for $70 a share, I am not going to issue new common stock at an undervalued price. What I'm going to do then is issue debt instead. So the market recognizes this logic, and so as a result, if the CFO decides to issue common stock, they recognize that she or he are going to do that only if the stock price is at intrinsic value or overvalued. And so sometimes the market worries that perhaps it was determined that the stock is overvalued, which is why they're issuing stock instead of bonds, and so it will cause the market price of the stock to come down some. And then preferred stock, as I mentioned before, you don't see it very often. Again, it is done electronically. I showed you a preferred stock certificate there, but anymore they're electronic shares. Most are cumulative, meaning that if you cannot pay the preferred stock dividend, which is fixed when the dividend or when the preferred stock is issued, if you cannot pay the preferred stock dividend, then it goes into arrears, and you can't pay any common stock dividends until all preferred stock dividends have been paid up. About half of the preferred stock out there are convertible, so just like your convertible bonds, okay, you can have convertible preferred stock, which can be used, you can use the par value of that preferred stock to buy shares of common stock at some predetermined price. Now, what is different with preferred stock is that the par value is generally not $1,000. It can really vary. The par value could be $100, it could be $200, it could be $250. It generally represents what the original selling price of the preferred stock was when it hit the market. So, but it's the par value that is converted into shares of common stock at some point in the future. And then, like I mentioned just a little bit ago, it pays a fixed dollar dividend, and that fixed dollar dividend is determined at the time that the preferred stock is issued. So what are the advantages of issuing preferred stock? Well, missed payments can be paid later, right? You're not forced into bankruptcy if you can't pay your dividends, although that sends a negative signal to the market if you can't pay your preferred stock dividends, and it hammers your stock price anyway, so you have to be really careful about that. Really about the only time I think you would issue preferred stock is if you, for some reason, you don't want to issue new common stock, which would probably be because you feel like your stock is undervalued, and you don't want to take on any more debt right now. Perhaps you feel like you're leveraged enough, and so this is kind of a hybrid, kind of an in-between hybrid form of financing that you can use. So you would go with your preferred stock financing. Another advantage is it avoids dilution of common equity. So again, if you didn't want to issue new common stock, another reason might be that you just didn't want to dilute your earnings per share anymore. Preferred stock does not do that. And then finally, there's no maturity date associated with preferred stock, although almost all preferred stock is callable, and they call it in at some particular time, at which time you'll receive the par value of the stock again. Disadvantages is, again, it's expensive because the dividends are not tax deductible, although it's not quite as expensive as new common stock, because preferred stock is considered to be safer than new common stock or regular common stock from a shareholder's perspective, because again, if the firm goes bankrupt, it's your bondholders that have first claim on assets, then your preferred stockholders, and then your common stockholders. Another disadvantage, though, is that it does increase the financial risk of the firm, particularly from the stockholder perspective, because again, they're paid last. So the bondholders get their interest first, then the preferred stockholders are paid their dividends, and then if the money's available, your common stockholders get their dividends. So it does increase the financial risk for the stockholder. These are just some weighted average cost of capital that are estimated for some firms you might be familiar with. I try to kind of find a variety. And I say estimated because firms are very protective of what their true cost of financing, true cost of capital is. So, so this is from Ernst & Young. Actually, I have the reference actually on this slide, but it's not showing. Um, but you see Intel has a 16% estimated cost of capital, which is really high. Probably a lot of that has to do with the high level of business risk. Obviously, the tech industry has a very high level of business risk, and so that's why we see Intel and Motorola as having your higher cost of capital. Also, the mix of financing, how much debt versus how much equity, is also going to have an impact on your cost of capital. Notice your companies that have less business risk. Go to the very bottom there. Heinz, Coca-Cola, very low estimated cost of capital, because they just generally have much lower levels of business risk. So how do you calculate the cost of capital? You don't have to calculate one for your company or your project, but just so you can kind of see what companies go through to actually calculate a cost of capital, what they'll do is they'll come up with the cost of financing for each source of financing used by the company, and then they take a weighted average of that. So just to kind of show you the formula, this is probably clear. You can see where the weighted average cost of capital is equal to, it's the proportion of debt in the capital structure. So if you're financing your assets, say 30% of your assets are financed with debt, your weight here would be 30%, times your overall cost of debt, and then we convert it. Remember, the interest on debt is tax deductible. So here we're converting your before tax cost of debt to an after tax cost of debt. We're considering the fact that that interest is tax deductible, and it makes the cost of debt cheaper. So that's 1 minus the tax rate there. Plus the weight of preferred stock, if you have preferred stock in the capital structure, times the cost of preferred stock, and then plus the weight of equity times the cost of equity. Now, I talked about new common stock as being equity, but retained earnings, using retained earnings, is also considered to be a form of equity financing, right? Because earnings belong to the shareholders. So if the company chooses to keep the earnings and reinvest it back into the firm, there's an implicit promise there that the management of the firm is going to give that investor a rate of return equal to the rate of return the investor would have gotten if they received the dividend in cash and reinvested in the firm themselves by buying new common stock. Does that make sense? So the cost of new common stock and the cost of retained earnings is the same, with the exception of new common stock is slightly more expensive because you have an investment banker involved that you have to pay, whereas with retained earnings you don't. But from an investor standpoint, investors expect to get the same overall rate of return from retained earnings than they would new common stock, because retained earnings is simply the firm reinvesting their money into the company, and so therefore they would expect a rate of return on that. So how does all this relate to capital structure? Well, firms will then try to find what mix of financing, so what proportion of debt and equity will minimize our overall cost of capital. And firms will review this probably semi-annually, possibly annually, to try to make sure that they're at the proper mix of debt and equity financing to try to minimize that overall cost of capital, precisely for the reason that I talked about in the very first slide. We're coming full circle now, that if we minimize that cost of capital, we maximize firm value, right? Because we maximize the net present value of all the projects, and whenever you maximize firm value, you maximize the stock price. Here's the here are the cost curves. So if on the horizontal axis here we have the proportion of debt that the firm is holding, so this, for example, this point here might represent 30% debt, this might represent 70% debt, okay, and here are your costs on the vertical axis here. Here's your cost associated with each of the sources of financing. Well, earlier when we talked about cost curves, we said the cost of debt went up very slowly initially until the market kind of determines, okay, you're exceeding what we feel comfortable with in terms of debt, and then it goes up very quickly here. Okay, that's your cost of debt curve. So, and we mentioned that it's the cheapest source of financing up to an acceptable range. Your cost of equity curve, we talked about how as you increase the proportion of debt in your capital structure, your cost of equity will increase each time, because stockholders have then subordinate claim on assets, right? As you increase the amount of bondholders in the company, bondholders have first claim on assets, so if something goes wrong, they now have less assets that they'll be able to claim. So their risk increases, so they react by demanding a higher rate of return. And so the weighted average cost of capital then is looking at, okay, if we're at, for example, let's say 10% debt, 90% equity, then our weighted average cost of capital would be, here. And so what you want to do is find that mix of debt and equity. This would be the optimal capital structure, because that's where our weighted average cost of capital is at its lowest. And so firm value would be at its highest here. Okay, so we want the mix of debt and equity that minimizes our cost of capital. Here, this is the same graph in terms of showing you value. So an unlevered firm is a firm that has no debt in its capital structure, and again, this is debt. And a levered firm is a firm that does have debt in its capital structure. And so the optimal capital structure is the proportion of debt and equity that maximizes the value of the firm. Some people might prefer to see it in numbers. So here, just very quickly, is the little table that I kind of put together. So if we have a firm that has no debt, okay, no debt at all, let's say, so we don't have any cost of debt here, so their cost of equity is 12%. So let's say that their stock then is worth $20 million. Okay, this is all given right now. So the value of the firm right now is $20 million. It's the value of the debt plus the value of the stock. So it's $20 million. And so right now, given the number of shares outstanding, we've got a stock price of $20 a share. There's no debt to firm value percentage because we have no debt. And so the weighted average cost of capital is simply our cost of equity, because that's the only source of financing we have. Now what we're doing, and this is kind of the analysis that corporations go through, although this is way more simplified. But what happens if we replace, we're not just adding $2 million of debt, we're replacing $2 million of common stock with $2 million of debt. And if we do that, we'd have to forecast what the interest rate would be. So we show that, okay, that would be about an 8% interest rate on that debt. And then the cost of equity, we said as you increase debt, the cost of equity goes up. And notice, I'll just show you that relationship as we go through here. Notice as we increase debt, and again, we're replacing equity with this debt. So in other words, we're decreasing the proportion of equity we're holding and increasing the proportion of debt. Notice how each time our cost of debt is going up, and see here we're seeing larger spikes in our cost of debt because apparently the market's determined about 8 million is the most you're good for. And then notice how the cost of equity increases as well every time you increase the debt. So the value of the stock changes. Now, the reason we've gone down from $20 million worth of stock to $18.8 million in total stock value is because, again, we've replaced some of the stock with $2 million worth of debt. And we're not just going to take $2 million off of here. What happens is the stock price actually goes up as a result of taking on the debt. So that's why this isn't just a flat 18 million. The stock prices actually goes from $20 to $20.89 because you're using a cheaper source of financing to finance your assets. Your weighted average cost of capital is cheaper. See, look, and we see over here our weighted average cost of capital is actually now 11.5% if we hold some debt in our capital structure in less equity. And so then we try it again at 4 million. And at 4 million, yes, sure enough, our weighted average cost of capital goes down again to 11.2%. So that tells us, okay, we want to hold whatever percentage that is, at least $4 million in debt and the rest in equity, which would be roughly 17.46 in equity. And then we try it again at 6%, or sorry, not 6%, $6 million in debt and see what happens. And notice again that the weighted average cost of capital comes down a little bit more. And then at $8 million worth of debt, our weighted average cost of capital starts going up a little bit. So, and you see it continues to increase. So for this company, the optimal capital structure, this is in dollars rather than percentages, but the optimal capital structure based on this graph for this company is to hold roughly $6 million in debt and the other $15.73 million in stock. If you'll notice, if the firm has that as a capital structure, firm value is maximized. See how your firm value is higher here than it is on either side? So it is at this level of debt and equity that our firm value is maximized. Notice our stock price is also maximized, okay, and our weighted average cost of capital is minimized. So this is what firms search for. This is what they seek to find when they're analyzing their cost of capital. They want to know what mix of debt and equity will minimize the weighted average cost of capital, maximize firm value, which maximizes the stock price. Okay, and that completes our discussion on cost of capital, and we will have then completed the objectives for the course. So thank you, and good morning or good night whenever you're listening to this.